Okay, this is the Chapter 3 and 4 exam review. And our first problem is we're wanting to find the amount of gross margin from the 4 transactions above. So assume this is a perpetual inventory method that we're using. That is, a perpetual inventory method gives you a constant, quick idea of what your inventory is immediately. As soon as you sell something, you know it comes out of inventory, and it also is recorded in sales. So let's go on with these transactions. And again, perpetual inventory is real-time inventory tracking, whereas periodic inventory, you only know what your inventory is whenever you take an inventory at the end of each month usually. But we're dealing with perpetual inventory. Okay, so here's our accounting equation. And here's some accounts we're going to use. And the first transaction, the company purchased $12,300 of inventory on account, which means they haven't paid for it, under the terms of 410 net 30, which means that they will get a 4% discount on this inventory, a cash discount, if they pay within 10 days. Otherwise, they have to pay the whole amount within 30 days. That's net 30. So you increase inventory under this first transaction by $12,300, and you also increase accounts payable by $12,300, keeping this accounting equation always in balance. Second transaction, the company returned $1,800 of merchandise of the supplier before payment was made, so they had a return. So when you return something and you put it on account, you take it out of inventory, $1,800. You're also going to take it out of accounts payable. All right. Now, third transaction, the liability was paid within the discount period. So we've got to figure out how much we owe this company, taking in what we bought minus what we returned, and then minus a 4% discount. So when we do that, we're going to reduce cash by $10,080. And that's the $12,300 originally purchased minus the $1,800 that was returned. And what that result is times 0.96, which is the 4% discount taken, means you're going to end up paying out in cash $10,080. So minus cash, $10,080. And we're going to reduce the liability by the full amount, which was on the books for $10,500. So we're not in balance. We have liabilities being reduced by $10,500 on the liability equity side, but we have cash being reduced by less than that, $10,080. So to make this stay in balance, we need to do this. We need to increase equity by $420, which is, you call that a purchase discount. So now the liability going down $10,500 and the purchase discount under equity going up, making equity go up $420, means this side, the right side, went down $10,080 and it matches the cash side. So we're not finished yet because we want to know what the gross margin was for these 4 transactions. So now we're going to sell all the merchandise purchased was sold for $18,600. So you increase cash by $18,600, increase equity by $18,600 under an account called sales, and now you can figure out what the gross margin was. Gross margin, oh, and by the way, I'm sorry, that's the retail side of the transaction, the increase to cash and the increase to sales. Now we're going to record the cost side of the transaction because it's a perpetual inventory system, and 2 things always happen. You record a retail part and you also record a cost part, which is how much this inventory cost is. So you'll take out of inventory, after you've recorded the sale, the retail side, you record how much you take out of inventory, which is $10,500, and you also record the $10,500 coming out of equity, which is going to be under cost of goods sold. So you've reduced your inventory on the asset side, $10,500. You've also reduced equity under the cost of goods sold by $10,500. So now let's put together the gross margin calculation, which is going to be sales of $18,600 minus cost of goods sold of $10,800 gives you a gross margin of $8,520. Okay, this next part you don't have to do, but I just want to keep you in mind that always this equation's got to always stay in balance. So when you bring these totals down, you'll find that you've got cash of $8,520. Your inventory is zero because you sold all of it. You've got zero in accounts payable because you paid off everything, even though you pay within a discount period. You've got everything all paid for. And then under your equity section, you've got $8,500. So you're all in balance. Okay, our next question, they want to know ABC's gross margin for year 2. They gave us information for all the transactions that ABC did in year 1 and also in year 2. But all they want to know is the gross margin for year 2. So let's figure that out. In order to get gross margin, you got to understand this idea that sales minus cost of goods sold equals gross margin minus operating expenses equals net income. And all we care about are things that have to do with sales and cost of goods sold in this year 2. So let's do it. Our sales come from this second transaction right here where we had $16,250 that was sold in inventory, which we sold it for $16,250 and it cost us $9,000. And so that $9,000 is the cost of goods sold, and our gross margin is the difference between the two, which would be $7,250. Notice we had nothing to do in this problem with we didn't care about anything about year 1, nothing, and we also didn't really care about anything with respect to transaction 1 or transaction 3. All they wanted to know was the gross margin, which was sales minus cost of goods sold. Let's go to the next one. Our next one, we're jumping now into chapter 4, which deals with bank reconciliations. So they want to know what is the true balance of cash as of April 30th, and we're given all this information about April 30th. The bank statement for ABC Corporation shows an ending balance of $35,649. That's what the bank statement shows. Okay. The unadjusted cash balance shows $29,550. So that would be on your computer screen on your accounting program. So this is the cash balance in your accounting program that's on your computer screen. This is the balance that you see on your bank statement that was mailed to you. And then they give you all these transactions, and they want to know what's the true cash balance as of April 30th. So here we go. So we're trying to find out what things we should be doing in terms of adjusting things on the bank balance side versus the book balance side. So the first thing we're going to do is we're going to put down our unadjusted balances. So on the bank statement, the unadjusted balance was $35,649. On the books, it was $29,550. And when all the smoke clears, we want to make sure that both of these things agree with each other after all the adjustments to them. So our first adjustment deals with deposit and transit for $44.88. You want to add this to the bank statement side of this reconciliation because it's something that the bank doesn't know about. We know about it. We knew about it on our books when we make the deposit, but the bank doesn't know about it until sometime later. So you want to add this. In other words, that deposit in transit is not included in that unadjusted balance. So we want to add that deposit in transit on the bank side. And next we've got a service charge. So up here it says bank service reports a service charge of $69, and we didn't know about that on the book side until we got our bank statement. So you want to subtract the service charge from the book balance. And next we've got a credit memo including the bank statement shows interest earned of $255. And again, you wouldn't know about this until you open up your bank statement. So you want to add that because that's going to increase your book balance. You want to add that to the book side. And then outstanding checks. These are checks that haven't cleared the bank. We knew about them when we wrote them, but the bank doesn't know about them because they haven't cleared the bank yet. So you subtract those from the outstanding, from the bank balance. That is transaction number 4. And then last but not least, we've got the bank statement includes a $1,170 NSF check. NSF means non-sufficient funds, means somebody gave you a check and had no money behind it. So you don't know about it until you open up your bank statement. So therefore you want to deduct it from the book side, right? And now let's combine all these pieces on each side and see if we have a true cash balance that is adjusted for both sides that agrees. So when you combine all these pieces right here on the left side, the adjusted bank balance is 28,566. Do the same thing on the book side, and that gives you an adjusted bank balance of 28,566, and it looks like we're in balance. Okay, our next problem starts off with, at March 31st, ABC Company had a balance in the cash account of $11,300. At the end of March, the company determined that it had an outstanding checks of $1,290, deposits in transit of $780, bank service charge of $50, and an NSF check from a customer for $230. What's the true cash balance as of March 31st? So let's see what we've got here. Adjustments to the bank balance and adjustments to the book balance. And let's see up here what things that we can make these adjustments to. So the problem tells us that we have a balance in the cash account, that's on our books, of $11,300 and it's unadjusted. They also tell us that we had outstanding checks of $1,290, which is something we would deduct from the bank side. So we'll put it over here on the bank side. Deposits in transit of $780, that's something that we would add to the bank side. Service charge of $50, that's something we would subtract from the book side. And an NSF check for $230, that's something we would subtract from the book side also. Now notice we don't have an unadjusted bank balance here. We only have an adjusted book balance. So the next thing we're going to do makes several assumptions, but it's the way to get the correct answer. The only thing we can do to come up with a true cash balance if we don't have an unadjusted bank statement balance is to rely on what's over here on the right side, which is the book side. So we're going to combine these pieces over here on the book side, and we're going to come up with a true cash balance of $11,020. And that's because it assumes that this information is all correct and that we can combine these pieces to come up with what the true cash balance is by just using one of the sides, in this case the book side. Okay, not enough information on the bank balance side to cross-check for a true cash balance. So we're assuming that everything over here is all correct and that that is our true cash balance per this problem. All right, our next problem is a homework problem that you'll see on the quiz, or the test, exam rather. It's over Chapter 3, it's 3-18A, and we have two companies. We have Bob and we have Tom, and they want us to take this information about this income statement for both of these two companies, and they want us to prepare a common size income statement for each company. Now, I'm only going to show you how to do one piece, which will be the Bob income statement, and with that you should be able to do Tom on your own or in the exam. So a common size income statement is nothing more than taking each of these pieces in this income statement and dividing them all by net sales. So for example, we have sales of $1,296,680, and this, as it relates to sales, of course, is going to be, and so before we get into that, this is real important too. Round your percentages to one decimal place. So if you take 1,296,680 and divide it by 1,296,680, you should get, that's right, you should get 100%. And again, that's how we did that. We just took, and we're going to take every one of these numbers in the column here that's under Bob's income statement numbers, and we're going to divide them all by sales to see what percentage they represent of sales. So the second one, cost of goods sold, it's 64.8%, And you'll do that by taking the 840 divided by 1,296,680. And notice I've got that in brackets. So you want to put yours in brackets, right? And when you get this in a calculator, it's going to come up with 0.648. And you should know to change that to a percentage, which is 64.8%. So again, when you divide 840 by 1,296,680, you're going to get 0.648. And you need to change that to 64.8. So slide the decimal places over 2. So our next one, gross margin, do the same thing. When you divide 840 by 1,296,000, you get 35.2%. Our next one would be operating expenses. Notice they're in brackets, so your answer needs to be in brackets. 26.8 is the percentage, and that's 347 divided by 1,296,000. Then finally, their income is going to be 107,920 divided by the sales, which gives you a net income percentage of 8.4%. Okay, and now that's all of Part A. Prepare a common size income statement for each company. So Part B, one company is a high-end retailer, like a diamond, they sell diamonds at whatever, let's say at a jewelry store. That's a high-end retailer. The other operates a discount store, which let's say that's like Sam's Club. Which is the discounter? By this information up here, can you tell which the discounter is? And by the way, I haven't revealed Tom's percentages yet on his income statement. I will in just a second though. So there are the information for Tom's percentages. And so the answer to this question is something that you should, number one, know from doing this homework problem, and or two, it's in your book, or three, you might even be able to Google it. How to come up with this last answer, which is, which of these two retailers is a high-end retailer, or which of these two companies is a high-end retailer, and which one is a discount store? You should be able to come up with that. Now, I've got one more problem that comes from homework that's on the exam, which is problem from Chapter 4, 4-10A. It's a bank reconciliation. And so here we have a formal bank reconciliation. This is the book piece of it. This is the bank side of it. This is the book side of it. This is doing it vertically as opposed to horizontally. So it says, as of June 30th, year 2, the bank statement showed an ending balance of 17,607. So there it is on the bank statement side. The unadjusted cash account had a balance of 16,772, which is what you see on your books. If you have a computer, it's on your cash account on your computer screen, and that's going to show up right here. And then we've got 4 things to figure out whether they need to be adjusted on the book side or the bank side. So let's do that. Let's see, deposit in transit, 2425. We should take the adjustment and add that to the bank side. Credit memo in the bank statement for interest earned was for June $14. That's going to be an adjustment to the book side. It's going to be a plus $14. Outstanding checks at $32.52. Those are checks that the bank doesn't know about, so we're going to adjust those as a subtraction or as a reduction on the bank side. And then we have a debit memo for service charge, $6. We don't know about this debit memo for $6 until we open a bank statement up, so therefore the books don't know about it. Therefore, it's a $6 subtraction from the unadjusted book balance. And now, if we've done all these things, we should come up with a true cash balance that agrees for both the bank and the books. So there's our true cash balance, 16,780. And it's going to be the same thing for the 16,780 for the cash side. We're in balance, everything's okay. And let's see, anything else? Negative amounts should be indicated with minus signs, so don't forget that in your problem right there. Negative amounts should be put on the books and with negative signs, and I believe that's all that you need to focus on for Chapter 3 and 4 exam. So good luck.